Something changed quietly, and in my experience, the most important changes in a system often happen that way. They do not arrive with a bell ringing. They do not always come with a speech from a politician. They do not always appear as one dramatic new law that everybody sees. They often happen through a series of small rule changes, enforcement changes, software changes, incentives, and institutional behaviors that compound until ordinary people suddenly discover that the system they thought they understood is no longer the system they are actually living in. That is what has happened around the $10,000 bank reporting rule. Most Americans over 60 think they know this rule. They think it is simple. They think if I withdraw more than $10,000 in cash, the bank files a report. That is it. They learned that idea decades ago, and because the number has stayed the same, they assume the rule has stayed the same. That is a dangerous assumption. The number stayed the same, but the environment around it changed. The banks changed, the software changed, the penalties changed, the reporting channels changed, the digital payment world changed, the way senior accounts are monitored changed, the way suspicious patterns are detected changed, and when a fixed rule sits inside a changing system, the rule becomes more powerful without ever needing to be rewritten. That is the principle I want you to understand. This is not just a story about banks. It is a story about how systems work. A system can tighten around you while every individual part of it still looks reasonable. One bank says it is protecting seniors from fraud. One agency says it is detecting suspicious money movement. One business says it is filing a form because the penalty is too high. One payment platform says it is complying with new reporting requirements. Each piece may sound rational by itself, but when the pieces are connected, the result is that an ordinary retiree can become frozen, flagged, reviewed, reported, and documented for doing something that would have looked completely normal to his parents. That is why I want to walk through this carefully in the last 2 years. The rules and practices around the $10,000 bank reporting system have changed in 5 meaningful ways. Each one matters by itself together. They make it harder, more expensive, and more dangerous for a normal retired person to move his or her own money without understanding the process. The first change can delay a large withdrawal for up to 72 hours before you see $1 of your own cash. The second change can turn a pattern of smaller deposits or withdrawals, even with completely clean money, into what the government calls structuring. The third change pulls crypto transactions, Zelle transfers, Venmo payments, Cash App activity, and other digital money movement into reporting systems that many retirees still think only apply to physical cash. The fourth change increases the pressure on businesses to file reports about you when you pay them in cash or cash equivalents. And the fifth change is the most important because it is not new at all. It is the original $10,000 number. Frozen in place since 1970, while the value of money changed around it. That frozen number is the root of the problem. Before I get into those 5 changes, I want to begin with a couple I will call Martin and Carol, because their story shows what a system looks like when it is not trying to hurt anyone but still produces a painful result. Martin is 71. Carol is 68. They live outside Phoenix. They worked for decades. Martin spent nearly 40 years in a regional management job. Carol was a nurse for most of her adult life. They were not speculators. They were not criminals. They were not trying to move money overseas. They were not playing games with the tax system. They were simply comfortable retirees who wanted to buy a car without financing it. They had negotiated the price. The total was a little over $40,000. They had the money. They had saved it. They wanted to pay cash, avoid interest, and keep their lives simple. That was the way they had always thought about money. If you have it, you pay. If you do not have it, you wait. That is a very old-fashioned, conservative, responsible way to think. So Martin went to his bank. He filled out a withdrawal slip. He expected to wait a few minutes, sign whatever needed to be signed, and leave with the money. Instead, a manager came out and asked him to step into a private office. The questions began. Why do you need this much cash? Did anyone tell you to withdraw it? Have you received any recent phone calls? Has anyone emailed or texted you about sending money? Have you met anyone new online? Is someone pressuring you? Martin was not being treated like a customer moving his own savings. He was being evaluated like a potential victim and possibly like a risk to the institution. Now, in one sense, I understand why the bank did it. Elder financial exploitation is real. Scams are real. Older people are targeted. Banks can see terrible cases where someone empties an account because a stranger manipulated them. The bank does not want that to happen. But the problem with systems is that they do not only catch the cases they were designed for, they also catch ordinary people whose behavior looks unusual to the software. Martin had a long record of normal small withdrawals. Then one morning he asked for $40,000 to a human being. That could mean a car purchase. To a compliance system, it means deviation. Deviation creates a flag. A flag creates a review creates delay, and delay creates real consequences in a retiree's life. Martin explained that the dealership was legitimate. He explained the purchase. He explained that Carol needed the car. He explained that the money was his. He had been banking there for years. None of that changed the result. The bank delayed the withdrawal for 72 hours. He had to go back to the dealership and ask them to hold the car. When the withdrawal finally came through, he thought the episode was over. It was not later he was told that a suspicious activity report had been filed. That report goes into a federal database and can remain there for years. Connected to future activity, that is the part most people do not understand. The pain is not only the delay. The pain is the file that now exists in the system. The next transaction is not judged in isolation. It is judged against the past pattern, including the prior flag. This is how financial systems become self-reinforcing. Once the system sees you as a pattern, the pattern can follow you. Martin did nothing wrong. Carol did nothing wrong. They were not trying to hide anything. They were not trying to evade a rule. They were trying to buy a car, but they ran into a modern enforcement system built around an old threshold to understand why this is happening now. You have to go back to 1970. The Bank Secrecy Act created the $10,000 reporting threshold in a very different America. In 1970, $10,000 was a very large amount of money. A gallon of gas cost a fraction of what it costs today. A new home was priced at levels that would look impossible to younger people. Now $10,000 could buy things that now cost many multiples of that amount. In 1970, a $10,000 cash movement was unusual. It was the sort of thing that could reasonably be associated with drug trafficking, organized crime, tax evasion, or other suspicious activity. But the number was never adjusted for inflation. That is the key. The rule was built for one monetary reality and then left frozen inside another one. If the $10,000 threshold had been indexed the way Social Security benefits are indexed, or the way tax brackets are sometimes adjusted, the threshold today would be many times higher. A transaction that should be treated like an $80,000 movement in today's purchasing power is still treated as a $10,000 movement because the statute never changed. That means the rule did not need to become more aggressive to catch more ordinary people. Inflation did the work. This is what I call a hidden tightening. A hidden tightening happens when the rule stays fixed but the world moves. The government does not have to announce anything dramatic. It simply leaves a threshold alone while prices rise. Eventually, everyday life crosses the line. A used car crosses it. A contractor bill crosses it. A medical procedure crosses it, a roof repair crosses it, a family gift crosses it, a pension distribution crosses it, an insurance payout crosses it, a home project crosses it. What used to be an unusual amount becomes a normal amount, but the reporting system still treats it as unusual. That is how a rule designed to catch extraordinary behavior begins catching ordinary retirement behavior. And once that happens, the burden shifts to the citizen. You have to explain, you have to document, you have to wait, you have to prove the pattern is innocent. That is the baseline. Now let me go through the 5 ways this system has become more punishing. The first change is the senior withdrawal delay. This is the Martin and Carol problem. Banks are now under far greater pressure to detect and stop elder financial exploitation. Again, the motivation is understandable. When someone in their 70s or 80s is being manipulated by a scammer, a delay can save their life savings. No reasonable person wants banks to ignore fraud, but incentives matter more than intentions. A bank that delays a legitimate transaction usually pays no serious price. The customer gets angry, the customer may complain, but the bank can say it was trying to protect the account. A bank that releases money to a fraudster can be sued, investigated, embarrassed, and punished. So the incentive is one-directional: freeze first. Ask questions later. Release only when the institution feels protected. That is why these delays are growing. The system is not designed around how urgent your need is. It is designed around how much risk the bank faces, and what counts as suspicious does not need to look suspicious to you. If you usually withdraw a few $100s and then suddenly ask for $12,000, you may be flagged. If you usually pay with checks and suddenly request cash, you may be flagged. If you usually move money electronically and now want a cashier's check, you may be flagged. If you are over a certain age and the amount is outside your normal pattern, the system may treat the transaction as a possible exploitation event. That does not mean the bank thinks you are incompetent. It means the bank is acting under a risk protocol. But from your side, the effect is the same. Your money is delayed. You may not be told exactly why. You may hear words like compliance review, processing issue, verification, fraud prevention, or account protection. Those words sound harmless, but they all mean the same thing in practice. The institution has put its control process between you and your money. This is the first thing retirees need to understand. The bank account is yours, but the movement of the money now goes through a surveillance and risk management layer that is much more sensitive than it used to be. The second change is the structuring trap. This is the one that can become most dangerous because many honest people accidentally do the very thing that creates suspicion. Structuring means breaking deposits or withdrawals into smaller amounts for the purpose of avoiding the $10,000 reporting requirement. The mistake people make is believing that if the money is legal, then the pattern cannot be illegal. That is not how the system works. The money can be clean. It can come from a house sale. It can come from a pension. It can come from an insurance payment. It can come from an inheritance. It can come from a perfectly legitimate small business. It can be your own money earned honestly, taxed properly, and held in your own account. But if you intentionally break it into smaller pieces to avoid the report, the government can treat the pattern itself as the problem. That is the part that feels counterintuitive to ordinary people. A retiree thinks, I do not want paperwork. I do not want to bother anyone. I do not want to trigger something. So instead of depositing $18,000, I will deposit $9,000 this week and $9,000 next week to the retiree. That feels cautious. To the algorithm, that can look like structuring. To the government, if intent can be shown, that can become a serious legal problem. For many years, people thought the danger was only in obvious patterns, depositing $9,500 9 times in a row, withdrawing $9,800 repeatedly, keeping everything just below the line in a way that no reasonable person could explain. But pattern detection has become more sophisticated. It does not only look for $9,900, it can look for $8,000. It can look for $7,500. It can look for repeated timing. It can look for related transactions. It can look for the behavior of the account before and after. It can compare the pattern to your own history. That is a major change. The system is moving from simple threshold detection to pattern detection. That means people who never thought they were close to the line can still be flagged. They may not be prosecuted. That is not the point. A flag can create a suspicious activity report. A suspicious activity report can create a review. A review can create questions. In some cases, it can lead to asset forfeiture where the government attempts to take money even without first proving a criminal conviction. This is why I tell people to think in terms of system incentives, not personal intentions. You may know your intention was innocent. The system sees a pattern. If you cannot document the pattern, you become dependent on the system believing your explanation later. That is a bad position to be in. The third change is that digital payments are no longer outside the broader reporting world. Many retirees still separate the world into real banking and informal digital payments. They think a bank transfer is serious, but Zelle is just helping a child. They think a cash withdrawal is formal, but Venmo is just paying a neighbor. They think a brokerage account is reportable, but a crypto exchange sits somewhere else. That distinction is disappearing. Crypto exchanges now have far more reporting obligations. Large crypto transactions can fall into the same broader anti-money laundering logic that applies to cash. Digital payment platforms have their own reporting thresholds, and those thresholds have moved lower over time. A $600 reporting threshold for payment platforms can pull ordinary activity into tax reporting that many people never expected. The issue is not that every personal payment is taxable. The issue is that reporting and taxation are not the same thing, and many people confuse them. A report can be generated even when the underlying transaction is not income. A family reimbursement is not the same as business revenue. Selling a used personal item at a loss is not the same as earning profit. A grandchild paying back dinner money is not the same as running a business, but the form may not understand the difference. The system reports gross activity. You then have to explain the character of the activity that creates a record-keeping burden. If your personal reimbursements, hobby sales, family payments, and side income all run through the same account, the system can produce a number that looks like income even if only a small part of it is taxable income. Then tax time becomes a reconstruction exercise. You have to separate what was personal from what was business, what was reimbursement from what was income. What was a sale at a loss from what was a taxable gain for an organized person. This is annoying. For a disorganized retiree, it can become expensive. And when larger transfers are involved, especially transfers above $10,000, the activity can connect to the same kind of federal reporting structure that many people thought applied only to cash. That is the third lesson. In the modern system, money movement is money movement. The form may differ, but the monitoring logic increasingly converges. The fourth change is the pressure created by Form 8300. This is the report businesses file when they receive more than $10,000 in cash or certain cash, like payments from a customer in one transaction or related transactions. Most individuals do not think about Form 8300 because they do not file it. The business files it, but that is exactly why it matters to you. When penalties rise, the business has an incentive to protect itself by filing. It does not want to make a judgment call in your favor and later be punished. It does not want to miss a deadline. It does not want to misclassify related payments. It does not want to appear casual around cash reporting. So if you pay a contractor $12,000 in cash, the contractor may file. If you pay a car dealer $15,000 in cash, the dealer may file. If you pay an attorney a large cash retainer, the attorney may file. If you pay in multiple pieces for one related project, those payments may still be aggregated. That last part is where people get caught. A retiree thinks, I will pay $6,000 now and $6,000 later. That feels smaller, it feels simpler, it feels less likely to cause trouble. But if the two payments are related to the same roof, the same car, the same legal matter, or the same project, they may still be treated as one transaction for reporting purposes. Then the attempt to avoid a report creates the exact pattern the system is built to detect. This is another example of how common sense and compliance logic can diverge. Common sense says smaller payments are less suspicious. Compliance logic says related smaller payments may be more suspicious if they appear designed to avoid a threshold. That is why you cannot manage modern money movement by intuition alone. You have to understand the rules of the machine. The fifth change is the inflation cascade. This is the most important because it explains why everything now feels more sensitive. The $10,000 threshold did not move, but the price of life moved through it. A retiree today can cross $10,000 many times in a normal year without doing anything unusual. A dental procedure, a medical bill, a family gift, a used car, a home repair, a small renovation, a mortgage payoff, a reimbursement, a distribution from a retirement account, an insurance settlement, a sale of an asset. Each event may be normal together. They create a pattern of reportable activity. That is what I mean by cascade. The problem is not one transaction. The problem is repeated contact with a system that treats each crossing as a potential data point. This is especially dangerous for older people because retirement creates irregular money flows. During working years, your financial pattern may be simple. Paycheck comes in, bills go out, savings accumulates. The pattern is regular. Retirement is different. You sell assets, you take distributions, you help children. You pay medical expenses, you replace cars, you repair homes, you move accounts, you may receive inheritances, you may make charitable gifts, you may move from accumulation to liquidation. That creates unusual transactions. Unusual transactions create flags, and flags create institutional behavior that is the real risk. Not that one form gets filed, not that one banker asks one question. The risk is that your normal retirement life can look abnormal to a system trained on your old behavior. So what should you do? The answer is not to panic. Panic produces bad decisions. The answer is to behave like a person who understands how systems work. You reduce friction before the transaction, you create documentation before the question. You use the channels that produce fewer false positives, you separate activity. So the records are clean, you stop trying to avoid reporting and start trying to make the reporting harmless. That is the principle. The first protection move is to pre-notify your bank before a large transaction. This is simple and it is powerful because it changes the transaction from unexplained deviation to expected activity. If you plan to withdraw, deposit, or transfer a large amount, especially above $8,000, call the bank in advance. Ask for the branch manager or the department that handles larger customer transactions. Explain the purpose clearly. Ask them to note the account. I am going to buy a car. I am paying a contractor. I am moving money to a title company. I am helping a family member with a documented down payment. I am receiving insurance proceeds. I am making a medical payment. The report may still be filed if the amount requires it. That is fine. A report is not the enemy. A misunderstood pattern is the enemy. When the transaction arrives and the note is already there, the system has context. A human reviewer can see that the transaction was expected. That greatly reduces the chance of a surprise delay. Do not wait until the teller window to explain a complicated transaction. At the teller window, the system has already been triggered. The employee may not have authority to override anything. You want context in the file before the software reacts. This is a very practical rule. Reduce surprise. The second protection move is to stop accidentally structuring. If you need to move $12,000, do not break it into two $6,000 pieces because you think that is safer. It is not safer. If the transaction is legitimate, move it in the legitimate amount through the appropriate channel, with documentation and a clear purpose. Let the routine report happen. You will usually never feel it. The report is just a record. What creates risk is the appearance that you designed the pattern to avoid the record. This is hard for people emotionally because they think being reported means being suspected. That is the wrong mental model in a modern financial system. Reporting is often automatic. The existence of a report does not mean you did anything wrong. It means a threshold was crossed. Your goal is not to avoid all reports. That is impossible and often dangerous. Your goal is to make sure every reportable transaction has a clean story, clean documentation, and no artificial pattern. Do not create a suspicious pattern to avoid a harmless report. The third protection move is to use wires or direct institutional transfers when moving large amounts. Cash is the most frictional form of money inside this system. It triggers the most questions, it is harder to document, it creates physical handling risk. It increases the concern that someone may be manipulating you. If you are paying a car dealer, ask about a wire. If you are paying a contractor, ask about a check or electronic transfer. If you are moving money to a title company, use the title company's formal instructions, verified independently. If you are paying a medical provider, ask for the institution's payment process. The more the transaction moves through formal channels with invoices, written instructions, and identifiable recipients, the easier it is to explain. That does not mean wires have no reporting. It means they often fit a cleaner institutional pattern. A wire to a car dealer from your bank with a purchase order attached is easier to understand than a 71-year-old walking out with $40,000 in cash. The system likes clarity, give it clarity. The fourth protection move is to separate digital payment activity by purpose. Do not use one digital payment account for everything. If you receive personal family reimbursements, keep those separate from hobby sales or small business activity. If you sell items online, track those separately if you have any income. Like activity, keep it distinct from purely personal flows. This matters because payment platforms often report gross amounts. They do not know the story behind every payment. If everything is mixed together, you will have to reconstruct the story later. Reconstruction is harder than separation. Separation also reduces the chance that the wrong total creates the wrong impression. A clean account with personal reimbursements is easier to explain. A clean account with business activity is easier to report. A mixed account creates ambiguity. Ambiguity is expensive in complex systems. Clarity is protection. The fifth protection move is to document every meaningful transaction before you need the documentation. For every transaction above $5,000, write down the date, amount, source of funds, recipient, and purpose. Keep the invoice, keep the contract, keep the car purchase agreement, keep the medical bill, keep the bank note, keep the email, keep the wire instructions, keep proof that the transaction had a normal purpose. A notebook is better than memory. A spreadsheet is better than a notebook. A folder with supporting documents is better than both. The reason is simple. When the question comes later, contemporaneous records matter more than explanations created after the fact. If a reviewer sees a pattern, and you can show that the pattern came from a contractor schedule, a car purchase, an insurance payout, or a medical bill, the pattern becomes understandable. If you cannot show that, the same pattern can look suspicious. Again, the point is not fear, the point is preparation. There is one more move that older account holders should consider, and it is especially important for avoiding senior withdrawal delays. Create a written senior banking authorization or trusted contact process with your bank. Different banks use different names for this. Some call it a trusted contact, some handle it through senior services, some handle it through wealth management. The core idea is the same. You give the bank advance information about the kinds of large transactions that are normal for you and the person they can contact if they are concerned. You can identify categories such as car purchases, home repairs, medical payments, family gifts, and planned account transfers. You can designate a trusted person who can be contacted if the bank suspects exploitation. You can ask the bank how to document your normal large transaction behavior. This does not eliminate every delay, nothing does, but it changes the bank's default posture. Instead of seeing every large transaction as an unexplained anomaly, the bank has a pre-existing framework. That is how you reduce the risk that a legitimate transaction gets held for 3 days. Martin and Carol did not have that in place when they tried to buy the car. After the experience, they created a clearer process with the bank. Future transactions became easier because the bank had context. That is how systems should be handled. You do not wait until the system blocks you. You put context into the system before you need it. Now, let me be clear about what I am not saying. I am not saying the government is wrong to monitor criminal money movement. I am not saying banks should ignore elder fraud. I am not saying reporting rules have no purpose. I am not saying people should try to hide legitimate transactions. That is exactly the opposite of the right lesson. The right lesson is that when a system becomes more complex, the cost of being informal rises. For many decades, ordinary Americans could handle money informally because the scale of life was smaller and the enforcement systems were less integrated. That world is gone. The combination of old thresholds, high inflation, digital records, compliance software, bank immunity, and automated reporting means that informality now creates risk. The safer behavior is not secrecy. The safer behavior is transparency with documentation. Do the transaction in the real amount. Use the right channel. Tell the bank in advance. Keep the records. Separate personal from business. Do not break payments into artificial pieces. Do not assume that because you know the money is clean, the system will automatically understand that it is clean. A good principle is this: never create a pattern that requires someone else to guess your innocence. Make the pattern explain itself. This is especially important for retirees because money mistakes late in life are more painful. A 35-year-old can spend years repairing a frozen account problem, a tax reporting problem, or a legal mistake. A 75-year-old does not want that fight. They want certainty, access, and peace. That is why prevention matters so much. The $10,000 rule is not getting simpler. The threshold is not being indexed to normal life. The digital reporting world is not shrinking. Banks are not becoming less cautious around senior accounts. Businesses are not becoming less careful around filing obligations. Algorithms are not becoming less important. Everything is moving in one direction: more reporting, more pattern detection, more institutional caution, more documentation, more integration between financial systems. You can dislike that trend. You can think it is unfair. You can think the threshold should have been adjusted decades ago. You can think ordinary retirees should not have to think this way. All of that may be true, but good decision making begins with reality, not with what we wish reality were. The reality is that a retired person moving meaningful amounts of money must now think like a risk manager, not because they are doing anything wrong, because the system no longer gives informal behavior the benefit of the doubt. The biggest mistake is to think, I have nothing to hide, so I have nothing to prepare. That is not how systems work. A person with nothing to hide can still be delayed. A person with nothing to hide can still be flagged. A person with nothing to hide can still receive the wrong form. A person with nothing to hide can still have to prove what happened after the system has already formed a pattern. Preparation is not paranoia. Preparation is respect for cause and effect. If you pre-notify the bank has context, if you avoid artificial splitting, the pattern is clean. If you use wires and formal channels, the money trail is clear. If you separate digital payments by purpose, the tax record is cleaner. If you document transactions, your explanation exists before anyone asks for it. If you create trusted, contact, and senior banking instructions, the bank has a safer alternative to freezing first. These are not complicated moves. They are small moves. But small moves made before stress appears are much more powerful than big explanations made after stress arrives. That is one of the most important principles in life and markets. You do not build the bridge after the flood has already washed out the road. You build it before. The same is true here. If you are over 60, or if you help a parent, spouse, relative, neighbor, or client who is over 60, do not wait until the next large transaction. Look at the accounts now. Look at the likely money movements in the next 12 months. Cars, medical bills, home repairs, gifts, estate transfers, insurance payments, tax payments, large deposits, large withdrawals. Then create a simple plan which transactions should be wired, which should be documented, which require pre-notification, which digital payment accounts should be separated, who is the trusted contact, what will the bank see if this transaction hits the system. Those are the questions. And when you answer them in advance, you change your relationship with the system. You stop being surprised by it. You stop triggering it accidentally. You stop letting an old threshold and a new algorithm define your financial life. That is the whole point. The rule may still exist. The report may still be filed. The database may still receive information. The bank may still ask questions. But you will have structure. You will have documentation. You will have a clean explanation. You will have reduced the probability of the worst outcome. In investing, I have always believed that the person who survives is not the person who predicts everything correctly. It is the person who understands the risks, designs around them, and avoids ruin when the system moves against them. This is the same. You do not need to predict every bank policy. You do not need to know every regulation by heart. You do not need to become a lawyer or compliance officer, but you do need to understand the direction of the system and behave accordingly. The old world said, "It is my money, so I can move it any way I want." The new world says, "It is your money, but the way you move it creates records, patterns, reports, and potential delays." That is not a small difference. That difference is the reason Martin had to explain himself in a private office to buy his wife a car. That difference is the reason ordinary people can be flagged for trying to be cautious. That difference is the reason digital payments can create tax confusion. That difference is the reason businesses file forms about customers they have no reason to suspect. That difference is the reason a number written in 1970 now touches ordinary retiree life in 2026. Once you see it, you cannot unsee it. And once you see it, the next step is not fear. The next step is to act intelligently, move money clearly. Document it, simply use proper channels. Do not split transactions to avoid reports. Tell the bank before the system is surprised. Create a trusted contact process, separate payment accounts, keep your own records. Those are the principles. The system is broader than it used to be. It is faster than it used to be. It is more automated than it used to be. It is less forgiving of innocent confusion than it used to be. But if you understand it, you can still operate safely inside it. That is the difference between being controlled by a system and navigating a system. A retiree should not lose access to money at the exact moment they need it. Most because nobody explained that the rules around a 55-year-old threshold had changed. A family should not be thrown into confusion because a bank algorithm misunderstood a car purchase, a home repair, or a medical expense. A lifetime of savings should not become stressful simply because the owner used yesterday's habits in today's enforcement environment. You have the map now. Use it before the next transaction, because the next time you need to move a meaningful amount of money, the question will not be whether the money is yours. It will be whether the system understands what you are doing before it decides to stop, flag, or report it. And the best time to make sure it understands is before the money moves.